Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. There's been a major shift taking place in the wealth management space over the past few years. In fact, I kind of think, we have been, or maybe we are at an inflection point here. Well, today is going to be another great episode as we focus on the wealth management space, particularly trends in the RIA space. And I have the perfect guest on who has fantastic insight and knowledge to share about the industry. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I would like to welcome Jim Gold. Jim is the CEO of Steward Partners. Jim, thank you so much for coming on the show. It's such an honor to have you on. I really appreciate it. Can you tell us a little bit more about yourself and Steward Partners?
Sure. Listen, thank you for the opportunity. Exciting times. Lots to talk about today. I'm one of the co-founders of the firm. So the firm has just started our 11th year now. I grew up in the business at Smith Barney, was a financial advisor back in the 90s and went into management and held various management roles. So a long Rolodex before Steward, but have been with Steward since the beginning and super proud of what we're doing.
Fantastic. There are a lot of trends happening within the wealth management space, whether it's on the investment side or practice management side, and the increased accessibility of AI. So let's start with trends in the RIA space. What are the primary trends you are focusing on?
Yes, I think if we could take trends and we could chat about the macro all the way down to the micro trends. I think the macro trend, which I think is underreported in the media, is really this titanic shift of the ownership of wealth management, right? So you look back 20 years ago, and the top 4, 5, 6 firms controlled over half of all the revenue done in wealth management. If you look at the most recent Cerulli report, which I believe is only a few months ago, that number's down to 37 or so. So in an environment with a record market, in an environment with a record productivity, record assets per advisor, yet you have 75% of the market share you had just 20 years ago. So this is a shift that is happening at amazing speed right now, and it's really accelerating. So if you look at that trend, the trend isn't going to go to zero like most trends, but there's going to be a point where it kind of flattens out. I think the big 4 become the big 3 at some point in the next few years. I think another one that might take a shot at an online trading platform, as some of them have already done, and that's another way to enter this space. But the key element here that I think is critical is that all of the market share they've lost has found its way to some version of independence.
Interesting. So what I think those facts are fascinating. When I started in the industry 20 years, I'm aging myself 20 years ago, it was the big 4, it was those big wirehouses. And I in Seattle, you have happy hour with all these other firms, and everybody was, Morgan Stanley, Merrill Lynch, and across the board. And now it's just a complete shift, and it's a fascinating shift. And to be honest with you, I kind of like it, and I'm sure you do at your firm. But what are the drivers? What's driving this shift between the big 4 and independent and hybrid RIA channels?
This is where I think you broke the walls down. It's the most basic things. It's technology and platform. And think about in the time you talked about 25 years ago, right? There were server farms with just computer after computer after computer. Now a top independent advisor can run their whole firm on their laptop and have just as good technology and resources as anyone at a major wirehouse firm. So that has created this real doorway to you can replicate all the tools you have and become unencumbered of the red tape and the bureaucracy of working for a very large organization that respectfully, and understand why, but they have to run the place down to lowest common denominator. And what you're seeing is the flight with their feet, and the top producers are leaving. So the trend of advisors managing over $500 million for the first time about 6 or 7 years ago now, there's more of them outside of those firms than inside those firms. So you're not just seeing these smaller advisors leaving, it's the bigger teams, it's the preeminent teams, it's the PWM type advisors that are realizing there's a whole other world out here they should be taking part of.
You brought up a good point about technology years ago, 20 years ago. The practice that I was working, it was within Piper Jaffray, the regional Midwest firm, and I was out in Seattle. And Piper Jaffray, the private wealth portion of the practice, the company was sold to UBS. And we weren't really big into UBS. We did a lot of our own research. They didn't want us to. And one of the options was to go independent. And after a bunch of research, we just decided, the technology's not there, the infrastructure is not there. Probably shouldn't. And we ended up moving to RBC instead, which is kind of had the similar feel as Piper, but we thought about independent, but 20 years ago it just really wasn't a viable option, I don't think, and now it is because of technology.
Right. Sure.
Steward Partners has been recognized as a top hybrid RIA recently and in years past. So my next question is about hybrid RIAs. What do hybrid RIAs look like, and what will they look like in the future?
Yeah, I think for us, the point of being a hybrid is we want to give folks optionality. So 86% of our revenue is done in our corporate RIA, which is obviously a huge part of who we are and what we do. Right behind that is planning. So 2/3 of our advisors CFP designated or higher. So you have a planning based advisory type practice, consulting type practice. But if you're truly a cradle to the grave advisor, as folks like to say they are, well, aren't you going to talk about life insurance and help them plan for that moment too? So that's where the hybrid comes in, because you can't do life insurance inside of an RIA. It's not advisory, right? So we want to give that flexibility. I think it opens up a product suite that's broader. It opens up the ability to truly serve the clients from that cradle to the grave, help their grandkids go to college and plan for their eventual estate. So that was important to us. I think the firms of the future are dealing with a lot of change right now. And I think some of these things that were unheard of, I mean, 20 years ago, you weren't worried about having a cyber attack on a small wealth management firm, right? If you see what's going on out there, these things are going on. There's billions of them a day between emails and the bigger ones that go on. So you have cybersecurity, you have ever-changing regulatory landscape that you have to keep up with. There's rules and regs. You have all the client information and PII and how do you protect that. So I think that's driving the M&A trend, because you're seeing these sort of smaller to mid-sized firms kind of throw up the towel and say, I can't, we don't have the bandwidth to deal with this. We don't have the capital. We don't have the team around us. We'd have to hire 30 more people to be able to run this company, and we don't have the capital to do that. I think it becomes another feeder for M&A overall.
That's fantastic insight. And, it goes along with AI. I was just recently at Wealth Management Edge, and a lot of the topics were AI. And it was really interesting. A few of the folks were talking about, AI is great, but until it gets into the hands of the wrong people. Now, the cybersecurity and those hacks and those deep fakes are going to get better because of AI. So, it goes back to cybersecurity. Like you said, cybersecurity is so important, and it's going to continue to be important moving forward.
Yeah. Yeah. And that's an expense line that these giant firms never had before, right?
Mm-hmm.
That level of technology is critical.
Mm-hmm. For sure.
So I think the one thing AI will never replace is the advice of a human being. And especially in a tough market, in the markets, in a bear market, you're going to call your robot and ask them how you should feel about your account being down 20%. I think that's really where the AI tool is going to be amazing for advisors. It's going to create bandwidth. It's going to create an enormous client service lift and synergy and efficiency that is needed in our industry. But there is a dark side to that we all have to keep an eye on.
Yeah, it's interesting you brought that up. Robo advisors 10 years ago, they were fantastic and everybody was talking about it. Big firms were buying up robo advisors, and it was just interesting. But though then you
Hmm.
have market volatility. It's interesting how all these new firms gain all this credibility and popularity when markets are up, 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 up,
Right.
and everything's fun and easy. And
Right.
then when all of a sudden there's a crisis that hits, it changes people. And like you said, AI is going to be great in many different ways, but when there's a crisis hits and markets fall 20, 30%, they're not going to call a robot, right?
Right. But yeah, and listen, it's a 30-year history, if not longer, of, oh, hey, there's online trading now. This is going to wipe out advice.
Yeah.
Remember the E-Trade commercial with the guy driving a pickup truck that owned an island, right? So there's always this next threat that's going to wipe out the need for advice. But the reality is, as we know, there's disparate groups of, there are do-it-yourself advisors that want to do it themselves and probably do a fine job for themselves, and they cover what they want to do. And then there are folks who say, hey, my situation is more complex, and I'm a brain surgeon. I don't want to worry about how to invest my account. I want someone to take care of me, or I'm a doctor, I'm an attorney, whatever it might be. So I think there's always going to be a need for advice. And as we all have seen, this wealth of information actually creates more confusion.
Yeah.
It doesn't create clarity, right? Everything's Google it. Just Google it now. It's like, great. Well, I Google, I get 874,000 possible answers to my question.
Yeah,
So,
exactly. And then you have all these Reddit, right? Look at what Reddit has caused to in the younger generation of investors. It's fascinating talking to them and advisors trying to connect with them. Like, where are they getting their information? Just getting information from the Wall Street Journal and
right,
maybe Bloomberg. They don't do that anymore, right?
right,
They get all
right.
their investment information from different sources that weren't around 10 years ago.
Sure. Exactly.
You brought up M&A, and M&A and the wealth management space has been very active. Do
Yeah.
you see that continuing, and how has private equity money impacted M&A in the overall RIA space?
Oh, I think the trend is going to continue. I'd say if we were a baseball game, we're in the first inning here. I
Wow.
think there's just so much more to come. I think honestly, what's interesting to me is that it's so woefully underreported. And you think about, we talk about the underground economy in America, right? And you pay someone cash, or your landscaper or whoever you're paying sort
Yep.
of off the books. Think about all the M&A that's going on that's not captured because there's not a banker involved. It's not on someone's league table. When, Jim Gold, on my own has a $500 million firm and I sell it to a friend of mine, that's not reported anywhere. So I think the volume of deals is 2 to 3 times what's reported. I think the volume of assets and revenue is probably not 2 to 3 times. These are smaller deals,
Yeah.
but there's a huge amount of deals going on and transactions going on that are not being reported anywhere because of their size. I think it's also hard to say. You'll see with Steward, you'll see teams leaving a wirehouse to join us, but in some cases they're selling us the business. So the industry might look at that and say, "Oh, they're recruiting a team in." It's like, well, we are, but they actually sold us the business, so technically it is an M&A transaction.
Right.
Um, so look, private equity is the fuel in the rocket, right? If you don't have capital, you don't have M&A, right? It's that simple. So they're I think the cause behind the cause, right? So a private equity firm doesn't run out and buy Jim Gold Wealth Management, a $500 million, $3 million revenue firm. They want to put their money in a firm that knows how to go acquire that, right?
Mhm.
So that gets into, everyone wants to be an acquirer, but I always say this is truly a seller's market. The sellers need to be focused on this and say, is the buyer the right decision for my clients? Because this is the most important decision an advisor will ever make on behalf of their clients. The single most important decision, period, end of story. So to me, I think a seller has to be very careful, be very deliberate to find out, what does it look like day one, day 101, day 301, 10 years from now, 5 years from now? How disruptive is it to my clients, right? Are we going to have to repaper everything? Are you going to have your models and all my models go in the garbage bin because now I'm working for this other firm? Is any of that good for the client, right? So I think the end of the day is, it's the old, Hippocratic oath, right? Which is do no harm. The least disruptive transaction is the best transaction for the client. The economics are the economics. There's not a lot of variation there, no matter who you're dealing with. But while everyone wants to be a buyer, not everyone's qualified to be. They don't have the resources. Do they have a transition team? Do they have expertise and knowledge of having done this? Do they have the capital to do it? And I really do think people lose sight of, are you as excited a month after that check cleared your account as you were the day it cleared your account, right? And you're going to know pretty quickly you'll have buyer's remorse or seller's remorse, excuse me.
Right. No, that's interesting. I love that you kind of gave considerations if you're a seller or a buyer. Are there some things that maybe advisors aren't thinking enough about if they're going to sell their practice? Maybe that kind of gets lost in the shuffle. Obviously, the client and their well-being is number 1 through 5, right? But is there something maybe that is falling through the cracks?
Yeah, well, I think the biggest thing that's falling through the cracks right now is we're in the middle of I would call it a succession crisis. So I've read statistics around something like a third of all advisors have no written succession or catastrophic plan, right? And so what we're seeing, I think, is a delayed reaction of the baby boomers now are starting to really retire, but that should be a multi-year process. That shouldn't be, you know what? I think this end of this year, I'm done. You know, it's Memorial Day weekend. I'm out of here by Thanksgiving, right? Because that's not good for your team. It's not good for the client. It's not good for anyone. So I think you need to have a multi-year approach. I think you have to ideally have your own successor in-house, right?
Okay.
We all know the G2s don't have the money to buy out the G1. That's where the transaction will take care of that. But at the end of the day, too, I would say for a seller, think about when you're selling your home. You hire a professional who comes in and says, yeah, you want to update that bathroom and you got to pave the driveway and your kitchen needs an update too. Or you can sell it as is, you're going to get much less valuation for this house. So a business is the same way. Every business has its challenges or its flaws. Every buyer is going to see them, right? If your average client is 90 years old, that's going to be very concerning. Is the business growing? Is the business retracting? Is it mostly brokerage? So there's a checklist of 15 items that any buyer is going to very quickly look through, and they're going to decide, are you in that, no pun intended, gold, silver, bronze, category of what I'm going to pay for your business, right? Everyone thinks they're a 24 karat gold franchise. Some of them are. But I think the sellers should take the time to plan for it, get your own successor, truly get your own house in order, align the things in your business that add value for you and for what you built. But I think be very careful of who you turn over your legacy to. This is, your clients are relying on you to make a good decision. It's critical.
Interesting. You talked about valuations, and I focus more on the investment side, obviously, but our valuations, and I'll be honest with you, I don't really know what valuations are right now in the marketplace, but are they stretched in terms of M&A, do you think, or have higher interest rates kind of brought those valuations down?
I think it depends. If you have to look at this as almost think of it as 3 separate markets, right? So you have sort of the beachfront hop property to the starter home, and then the McMansion in between. I think on the lower end, and listen, if you think about historically, 10 years ago, if you said, hey, our firm has $3 billion, you were, wow, you have $3 billion, you're a player, right? That number's 10 billion today. If you're sub 10 billion, you're not looked at as a larger franchise, right? So I think on the very low end, I think valuations have come down, and I think they're in the high single digits of EBITDA is what we're seeing, and that's simply because of financing costs, right? Because normally advisor A is buying out advisor B until advisor A goes to the bank and they tell them about the 12% interest cost, and suddenly they go back and say, yeah, we're going to need to renegotiate this. I didn't realize that the carrying cost can be that high in your note. So that's definitely driving there. I think the premier franchises are actually seeing a valuation lift. We're seeing more turns of EBITDA on the high end because that space is getting thinner and thinner between, the best firms have risen to the top, coupled with some acquisition activity of these larger organizations. So if you're an investor, whether that's a existing brokerage firm, whether that's a bank, whether that's a private equity capital, and you want to, get it in the game, you basically say, okay, we're gonna have to buy something of size, of scale, with a track record, with the leadership team, with the capital and the resources to continue to grow, because that investment has to double and triple and quadruple in value for the economics to make sense for everyone.
Fascinating. Great stuff there, Jim. Thank you again for coming on. Any fun story, interesting item you've experienced recently? It could be in, professional, personal, anything, over the Memorial Day weekend.
Things are busy right now. I always say I'm going to write a book about my wealth management career. I've seen lots of crazy things. I'm trying to think of one I could share on your podcast, though, and nothing's coming to mind.
No worries.
But
No
it is
worries.
entertaining space for sure. Never boring.
Yeah, I love it. I mean, every day you wake up, it's something new, whether it's in the markets or movements and,
Yeah,
just the space, mergers, people are retiring.
right.
Yeah, it's fascinating. It keeps the headlines moving, that's for sure.
No doubt. No doubt.
Awesome, Jim. Again, thank you so much for coming on the show. I really appreciate it. Where can our audience get more information about Steward Partners?
Yeah, if they want to visit our website, it's www.stewardpartners.com. There's information about the firm. We have an amazing team, an amazing board of directors, and for investors out there, we have a couple of hundred plus really top advisors that always like to work with a new prospect or client. So if you're looking for advice and a second opinion, our advisors are happy to give it.
Fantastic. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much and have a great rest of your week.